Check. Check 212, check 212. Guys, welcome to a special midweek update. Today, we actually have the FOMC meeting with Fed Chair Jerome Powell. One of his final moments, really, as Fed Chair. Guys, don't forget to grab your drinks, grab your beers. I think GG, he got his beer ready already. We're also going to play some actual bingo today, because I don't know if you guys seen this, but let me open up quickly. This is, by the way, how we're going to watch the stream, and also how we're going to see if we're going to get a rate cut, yes or no. But didn't know if you guys knew this, but basically we have a bit of a bingo going on. So, for example, how many times is Jerome Powell going to say the word inflation? 40 plus time. 25% times. Tariff. Again, projections. Will he start with good afternoon? That's the question. 95% chance that we'll start with good afternoon. Interesting. Welcome John. Welcome GG. Welcome Swerford as well. Blaze as well. Good to see you guys. So, what we're going to do for this stream specifically, every time we hear the word inflation, we're going to do one of those. So I hope for you guys is that we're not going to get 40 times inflation. 80% chance that we'll get a 40%. We will get 40 plus of these air horns. Okay. It already gets annoying, isn't it? But let's make it a bit more fun, because honestly, it's often it's quite a boring speech. I'm not going to lie. It is quite boring, guys. What's up, Acts? Good to see you. I see Star Fox strapping in as well, but I'm delivering some mail, so I can only listen. I hope I don't scare you while I'm doing the air horn. I took an early lunch. Welcome. Strap in, stupid. Strap in. I also see a robot again, guys. We are live on a Wednesday. We do this every Thursday and Sunday typically, but tomorrow we have no live stream. So what's happening? Before we truly go into the nitty-gritty details, really, of the whole FOMC meeting, this will only start in 10 more minutes. Let's quickly take a quick peek at the chart, because honestly, I'm amazed by what's been going on here with the Bitcoin dominance chart, because I don't know if you guys really noticed, but Ethereum is on a freaking roll. Welcome, VDG. Welcome. So, do you see this, guys? The W is playing out perfectly here for Ethereum. So you can see we've got basically two bottoms that are the W formation for Ethereum. So I do expect that in the short term, we'll go at least to about here, 3,500. So this is looking good. We might get some scares though, guys. So in a few more minutes, we'll get the FOMC rate cut. I need to bring up the actual other chart as well. Let me know, by the way, in the poll, what you think. Do you think 0 BPS, so 0 basis point rate cut? Do you think 25 or do you think 50? I think already somebody mentioned earlier, but if we get 50, if we truly get a 50 basis point cut, and that's something that Trump truly wants. Trump wants a big cut, but let's say we got that, guys. I think it's too much today. Welcome, Carlos. Good to see you. If he get a 50 basis point, but I don't think so. I'm not so bullish. Pro is hovering at about 10.5. Really nice. What I quickly like to show you guys is that we are now, specifically for Bitcoin, at an important level, because we are now finally above the 21-day. And you can see we have had a test, another test, what we keep above the 21-day. And the 21-day, that's truly the short-term bullish or bearish barometer, because since we lost support here, since we dove down below the 21-day, you can see we got a big rejection here. We got another big rejection here. And we tested it again and we failed once more. So the 21-day, guys, has been rough resistance. But now, we are here. We're above it. We tested that support as well. So this, guys, is truly, I would say, a great sign for the immediate short term. Bitcoin above 92k, and it needs to fill this green box. At the toilet. Oh, what did I do? What did I do? Did I use some sound? No, no sound. Interesting. What's up? What's up, guys? Welcome. I think you have to refresh. Let me quickly sell it to you guys. Welcome, welcome. Okay, welcome guys. 212, check 212. We can hear you. Nice, nice, nice. So, Bitcoin, guys, is performing great so far. Like I mentioned, we are above 92k from very crucial levels. And yes, we had a rejection yesterday. Of course, I would love for Bitcoin to be even stronger. But we can see we're trading within these ranges here, and that's fine. We have to respect the ranges. We respect the ranges here. Welcome, guys. By the way, if you're new, don't forget to hit the subscribe button, because we're getting very close now to 10,000. Yes, 10,000 subscribers. So please join me on that journey. So what else is happening now? Let me get the FOMC here. Yeah, the FOMC meeting, guys. It's happening in a few more minutes. Chat is disabled for live stream. Oh, we can't chat with Jerome Powell. Happy to see you, Gigi. Welcome again. Yeah, sometimes YouTube doesn't auto-refresh. It's really annoying. It is really annoying. What I also like to use typically, guys, is Cryptocraft. And what's Cryptocraft? Well, I recommend to anyone out there to check this website once in a while. Because this website, it summarizes all the important dates for crypto. So, for example, yesterday, we got the JOLTS job openings. I think one of the reasons why Bitcoin yesterday went so good, and also why Ethereum was so good, was because the job numbers were decent. They were not too scary. They were basically very close to the expectations, or close to the previous numbers as well. So yesterday we had the job numbers, JOLTS. And you can see that we now also have here the forecast for the federal funds rate. Previously it was 4%. It's really small, but you can see 4%. We expect it to become 3.75%, but you can see it's now counting down. In 5 more minutes, we know the exact number. So check out this website, guys. It's called Cryptocraft. And there you can find all the important data, and it's directly all nicely summarized on just one page. Hey, what's up, Crush League? I'm disappointed, but market conditions haven't arrived yet. That's why this meeting in a few minutes will be so important. They can... So... thank you so much. Thank you so much. Robert, let's fucking strap in, mate. As a true Peaky Blinder. Thank you so much. I need, like, the hat. I think that the guy, I lost the name. The guy with the mustache, he has a nice hat. Looks a little bit like a beret. Yeah, thank you so much, Robert. Right in time right now, again, for the FOMC. Let's actually invest that in Cronos. I think it might be worth more in a few minutes. Welcome, welcome. So, I wanna quickly give you guys a bit of a warning. Quick warning here, because the FOMC meeting is often very volatile. So if you have a long open, or if you have a short open, I recommend to close it. Because even though you might expect maybe a bullish pump, the opposite can happen. Like, it can be a sell news event, it can be a buy the news event. Nobody truly knows. So make sure, guys, your risk is adjusted to the volatility that we're probably going to see. I will probably switch to like the minute chart in a minute. Guys, do we do minute charts, or do we do... Yeah. Shall we get the Crow chart, or shall we get the Bitcoin chart? Let me know. Last 3 times it went down. I think the last time it was basically nothing happened until the speech. So we had a very bad speech back then. Today is a minor red day. It's not good for your heart, is it? No, it isn't. It definitely isn't, guys. Warner saying crow chart. Stacy saying crow chart. Swerford saying Bitcoin chart. Okay, it's 2-2-1 so far. Guys, let me know. And also don't forget to fill in the poll and hit the like button. Robert saying crow chart. You can also get the total crypto chart. We can also switch now and then, that's true. Okay, so far the crows are in the lead. We go to the 5-minute chart. You can see that the last few days it was crazy. So yesterday we went up to almost 11 cents, but we're still range bound. You can see this line here. We have been respecting this line for a long time. So once we break it, guys, that's a great sign. So again, I'm hoping for a clean break here at about 10.8. And then we have to retest here the purple line at about 11.2. That could be cool. Hey, Coin Baron, one thing. I want a pair of suspenders from the Coin Baron brand. Tell me how I can do it. Robert, if you join the Discord, I will get you some. Join the Discord, make a ticket. Make a ticket. You have to go to the Discord. And by the way, guys, the Discord is open to anyone. So join the Discord. We also have good discussions over there. And then you can go to somewhere. I think we got ticket. All you gotta do. Join the Discord, link is in the description down below. So guys, get ready. A few more minutes, and we're gonna get the numbers. Then we're gonna get the US federal funds rate. And this is so important because this will basically change how the international markets look at treasury yields. And guys, the lower this is, the lower the Fed funds rate becomes, the less interesting the dollar becomes. The less interesting the dollar becomes, and the less interesting the dollar becomes, the better it typically is for assets like crypto. If nobody wants to hold Bitcoin for the yield, then nobody wants to hold US dollar for the yield, then you go to Bitcoin or to stocks. And we have only 30 more seconds left, but the S&P, guys, it's doing good so far. S&P is close, very close to an all-time high. So stay tuned, guys. Welcome. Who wants dollars? Well, I want dollars to buy the dip, but that's it, guys. 9, 8, 7, 6, 5, 4, 3, 2, 1. It's 8 o'clock. It is now pending. There we go. 50. No, 25. It's 25, guys. As expected. Nothing too crazy. S&P is going up. What's happening with the Crow? Crow's going up as well. What's Bitcoin doing? And we're going live, guys. Bitcoin, small pump. So far, so good. We can do better. We can do better, as expected. Nice.
Online resources for students from kindergarten.
160. We're going.
Classroom lessons, online education, publications, and more.
I don't know why we have no ads on the Federal Reserve.
Or as they see fit. Many of the Federal Reserve System's regional
GG, guys. Well played. Good first pump. Let's see.
In-person and online professional development.
Yeah, I agree, Mr. Enlightenment, because sometimes no news is good news, right? No news can be good news.
At the board and reserve banks, students
Please use the last second to hit the like button, guys, and subscribe. 10,000, please, today. I would love that. I would love 10,000. Like, that would be a Christmas dream come true to me. Okay, we're going down again. It was a small party, but it's still good.
The availability of easy to understand resources that explain personal finance concepts.
We're now green on the daily. That's good.
And the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators.
Federal Reserve
educating
Education.
students, and
You can see we quickly went above 93 today, just a few minutes ago. It's a pump and dump, guys. It's Bitcoin.
Federal Reserve Education.
Welcome, welcome. To anyone who are watching the FOMC, and it's just starting. Don J, welcome, welcome. I think we're going live in a few seconds, guys. They're just doing all the... I don't know why they're doing this. Yeah, they are still just talking about what the Fed truly is, what they do. I'm quickly muted them because it doesn't really matter. I want to see the speech. I want to see the speech. Javello, welcome, welcome. I love where Cronos is heading, going to DCA a lot. I think it's a good strategy, guys, to DCA. HODL. Because you can see, right, it makes no sense. We go up, then we go down. Trading in this market sometimes is truly very hard. We were celebrating a bit too early, maybe. Ah, it goes live in 30 minutes. No, I forgot. I forgot it's 30 minutes later. Ay, ay, ay. Ay, ay, ay. To be honest, it's quite disappointing how little volume there is. Yeah, it's a shame. Okay, in that case, guys, we'll keep the stream open, but let's do it like this quickly. We're going down. We're going down. Welcome, welcome, welcome. So, quickly recap. We got a rate cut of exactly 25 basis points, all as expected, which is, I think, good news. Now we can look forward to the speech by Jerome Powell, and it should be hawkish. It should be dovish, I mean. That would be good for the price overall. Crypto seems to have changed the cycle. A smaller DCA, but over time leave dry powder. That seems to be the way to do it. We also now have AI trading bots and high leverage. And that really made this market more unpredictable. As also the institutions, right? Institutions buying in. Oh, whoa, whoa, whoa. Is this true? In the next 30 days, the Fed will buy $40 billion in government bonds. That would explain the initial pump here. Because, guys, if that's the case, if we're buying more, that's printing. We're printing basically. Interesting, very interesting. Let me quickly go to Twitter, guys, because typically on Twitter we'll get all the latest news. So let me open up Twitter because we might read some more about this. Let's see if we can learn a bit more. FOMC. Let me check. I've got some interesting things. So, as expected, rate cut 25 basis points. Everybody is basically saying the same thing. Let me check if I can find it. So, guys, according to Björn, 40... Let me just go search for 40 billion. Maybe we can find it here. Welcome, guys. We had a rate cut. That's good news. It's very good news that we have a rate cut. Ah, okay. So it's not the only one. Buying 40 billion starting December 12th. That's already a bigger deal than the cut itself. So this is breaking news, guys. This is truly breaking news. Not yet QE. But this is looking much like it. This is much looking like it. So for anyone wondering where can I find this? Well, what happens basically is that the report, where also you can actually get the all the information about the release. It should be somewhere over here. So there's an actual report, and there should be also some more details about the rate cut decision and also the forward-looking statements. And basically with this half an hour break, I think it gives people, reporters, the time to also look into this and also ask questions, for example, about the 40 billion. And I think this will be the topic of today. This will be the topic of today. And yes, I think somebody mentioned this. 40 billion is a good start, but it's only a tiny drop in the bucket. Yeah, true. True. But it's the beginning, right? It's the trend. We start with something new. I bloody spent 150 quid on a couple of nights out with my family recently. I was thinking, is this my TCA money? I have to say, when I'm going out for dinner, I'm like, oh no. There goes my investment. Because that's gone, right? That's gone. At least the investment sometimes goes up first. Okay, guys. I think like fundamentally it is bullish. It is fundamentally bullish what just happened there. So the market, it's scary, right? But this typically happens. 5-minute charts. In the grander scheme of things, I believe it's a good start. Moonlander looking interesting. It is. I'm gonna like this news. I like this news, guys. Good stuff. I will try to also find the Fed fund trades. But I think the bigger news story is what just happened with the S&P here as well. Do you see this? We're getting very close to where we left off on Thursday last week. If we pump only 0.4%, 0.4%, we are catching up to the previous high of the S&P that we set last week. And then we have the all-time high a little bit higher. We need to pump less than 1%. Less than 1%, guys, to go to a new all-time high for the S&P. The DJY, the Dow Jones Index, basically same story. Well, 1%. Nasdaq, a bit more than 1%, I believe. About 2%. The stock market, guys, is ready to rip. What's gold doing? Gold is green. People selling dollars to buy gold still? Let me check if what just happened an hour ago. Yeah. So basically everything is going up. So everybody's liking the news so far. Check the A-ball. Dear A-ball, Mr. of the future, what will the rate cut do? Will it be bullish or will it be bearish? Are we going to $100,000 for Bitcoin in the upcoming week? That's the question. You're able to $100,000 for Bitcoin in the next week. Potentially. Well, that's the most uncertain outcome I've heard from the A-ball in a while. Nice. Welcome, guys. Good to see you guys. Don't forget to strap in, hit the like button. Today we're watching the FOMC meeting live with Jerome Powell, the Fed chair. We had a rate cut of 25 basis points, and it is looking good for the market so far. Bitcoin heading again to about $93,000. But reserve. I'm always doubting which one it is. Shit, I forgot. This is not the one. This is the overnight reverse repurchases. I'm looking, guys, for the I forgot the one. It's not my best day today. Okay, let's go back to the actual charts here. So Bitcoin again. Bitcoin is looking strong. Bitcoin is looking very strong today. I think we will fill the wick here and we'll go back to 93, meaning also that CRO probably will have a bit of a reversal soon. Also, we have the Bitcoin dominance. And guys, we've been talking about this, but the direction is clear, right? Direction is really clear. So Bitcoin dominance, for anyone that's new to the channel, Bitcoin dominance is basically a graph of everything, all the altcoins versus Bitcoin. And when this goes down, we typically call it altcoin season. And the question is, what is the trend? And the trend, I would say, is bullish for altcoins. And that's one of the reasons, guys, why fundamentally I'm so bullish on this space. I'm bullish on the space because currently we see the first signs of QE, so money printing. We see the federal fund rates go down. We see ETFs being approved. We see a treasury company start up for the CRO token. We see treasury reserves for all kind of different tokens. Like fundamentally, all the right puzzle pieces are getting into place. All the right puzzle pieces. And maybe the fact that everyone is so bearish makes me even more bullish. Like, think about this as well. When we had the 10-10 event, you might still remember the 10-10 event. Oh, yeah, the 10-10 here, you see. CRO went down from 20-ish, 21. From 212, CRO went down to 6 cents. We thinned out the complete order book. Like the whole leverage on the downside has been removed now. So if anyone wants to manipulate the markets, I would say next time we manipulate it to the upside. So again, the puzzle pieces are now laying on the ground. It's time to get them together and start preparing for an actual euphoric run up. Coin Baron, do you think CRO will hit a point where it stops with the massive pumps and dumps and switches to a more gradual increase and decrease? That's a really good question. That's a really good question, L. Blake. So I believe so. I do believe so, because currently Bitcoin, like CRO is very, very immature as an asset. And I need to go back all the way to, I think this is the best example. I can't go much further back, guys, but this is Bitcoin. And Bitcoin, it also was a shit coin, to be honest. Like in the early phases, and I'm talking about 2010, it went up and down, up and down. CRO, well, it looks old. It's only like 6-7 years old at this point. Yeah, about 7 years old, I believe. It started in 2019 or the end of 2018. So once we get into a more mature, into a more mature market, especially also with ETFs, with the treasury, I actually do believe like the treasury can act as a floor price. Because basically what can happen, and that's, if I was running a treasury company for CRO, I would make sure that the CRO price is basically stabilizing at a certain level. But on the other end, I don't know how easy it is to control the pumps. Like, okay, let me ask this to you, Mr. L. Blake. So let's say that this doesn't happen. This doesn't happen. We only have here one steady uptrend, but it's just very slow because we have a oh, you can't see it. Oh, that's a shame. Okay, so let me repeat it once more, guys. 50 more minutes till we get the FOMC meeting, so stay tuned, strap in. So let's assume here that this didn't happen. So oh, it's hard to see. This whole pump. Let's assume this didn't happen. If you take a look though, like if we kill the noise, we are slowly going up. You can see this is a logarithmic regression line, but it's going up. If you kill the noise, we do have pumps, but yeah, we are slowly going up. Same thing here, right? Same thing here. We have a slow increase, but also with a lot of volatility. I don't mind the pumps, but so what I think is that at some point, we probably will see something like this. So we still have the pumps, but at least they are less, they are probably less, how do you say that? Less intrusive or less big, because that's the scary part, right? It goes up and it again dumps 70%. It creates a higher low, which is the most important thing. It creates a higher low. This is a low, higher low, higher low, higher low. Hopefully again also a higher low. But But I do believe once we get more mature with the ETF, with the treasury, that will probably be more like it. There we go. Crows back above 10.5. What's Bitcoin doing? Bitcoin is now very close to 93. Crow has less volume to stabilize. That's also true. That's definitely true. Yes, there we go. Bitcoin above 93. Nice, nice. This was a CME watch tool. Yeah, they were right, 91%. SHIB is lagging. I don't trade SHIB myself. Welcome, Johnny, by the way. You thinking 50 cents at least this week? Come on, Crow, you can do it. Winter is coming. We can have a center rally, guys. I'm prepared. I'm mentally and physically prepared for center rally. If we close above 50 cents, I will do next stream with a center hat on. I was trapped in as center. I think that Santa Claus also wears suspenders. I do believe so. The dot plots seem equal to the one before. No big changes. That's good. People like things to be the same. So anyone wondering what dot plot is all about? So the Fed chairs, they all have a discussion together, and they basically provide an outlook, a forward-looking outlook. So hey, what do you guys expect in January or in March or in April? Or there are these meetings. There's FOMC meetings let's say every 1.5 months, give or take. And what happens then is that all the Fed members, they provide their own outlook, and this will create those dot plots, those scatter chart dot plots. You can see, by the way, that for interesting, for April, there was definitely still no consensus. Some people even think it will remain where it is now. But yeah, I do believe it will probably slowly go towards the neutral rate at 2%. We're not there yet, though. Definitely not. Hey, Trading Savior, welcome, welcome. If Crow goes up to $1 in March 2026, next time I will travel to Amsterdam. Nice. We can have a meeting next year again. So if anyone wondering, we had a meeting earlier this year. We had a meeting at Bitcoin Amsterdam. Like I met up with Swerver. Swerver is in here. He was great. We had a meeting with Ezra. We had a meeting with so many cool people, honestly. And I would love to do more meetings like that. Honestly, it's so cool. I thought he was saying center rally. No, center. Man, Bitcoin is sometimes such a shit coin as well. Come on, please break above 93. Please, 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 please. Do you think that Crow will be like the next Amex or Chase or Bank of America? Yes and no. Like, yes, because it will function as the bank of crypto, but no, because I do believe it's going to be a lot better than any bank will be. 10K till Christmas. Yes, please. Guys, don't forget to subscribe. We also had Kai there, by the way. Kai, welcome. We drank some beers with Kai. Quote of the year. Yeah, sometimes, GG, sometimes it's boring. I want to see it, go up and down, but then only go up, please. I don't know. The news is good. Everybody's just afraid of what Mr. Jerome Powell will say in a few minutes. It's not yet live, guys. We're still waiting. We're still waiting, guys, for some more news. We have to wait until March. That's the promise by the CEO, by Chris Marszalek. True. I'm honestly, I do hope, guys, and I have a feeling, it's not confirmed yet, but I have a feeling that very soon we will get the 2026 roadmap for Crypto.com. So anyone wondering what's this Crypto.com roadmap. So here we got the roadmap for 2020. Here we had the roadmap for Crypto.com for 2025 and 2024. This roadmap is almost completed. We have now, for example, I need to scroll to the right. We have, for example, now Cronos 1. We have the AI-powered trade tooling. We have not yet the Crypto.com stablecoin, but the majority things we do have here. So I'm looking forward to the next roadmap, and typically on these roadmaps there are also great surprises. So I hope so. I really hope we'll get some more surprises going forward. What else is happening? So the rest of the week, guys, we won't have much to talk about. We'll have the US unemployment claims, but not that interesting. So this week, I would say the FOMC is the most important thing this month, maybe even. Next week, on December 18th, we'll have the US CPI data. So everything regarding inflation. We expect it to be probably about still 3%-ish. But there are no actual forecasts yet. Oh, also next Tuesday we'll have the job numbers again. US non-farm employment change. Hey, Carlos van Dam. Thank you so much for subscribing to the channel. I think we're getting close now to 9,970-ish. So thank you so much for joining the club, sir. Can I order my Lambo now? Yes, please. I want one in orange. I've got the BMW in the back. The BMW would also be fine. I'm a big BMW guy. I never owned one though. So from what I hear from BMW owners, it's really expensive to maintain one. Or relatively expensive, let's say it like that. I have actually an electric car because of the low maintenance cost. Do you think we'll go see a altcoin rally? I do believe so, sir. If you take a look at Bitcoin dominance, it's in a clear trend. And it's basically the same as what we happened in 2021. Do you see that after the breakdown from this consolidation range, it went quite quick? So it's not going as quick yet, but I think it can go really quick after today. I think that can be a center rally. I truly believe it can. And Ethereum is the true winner so far of the center rally. So I'm unsure how to respond to the Cronos 1 development. I'm already pretty active inside of the app, and I don't know what else I can do for me at the point. What am I missing? You're not so active inside of the app. You're missing so many things, David. We have to talk about it in a different stream, I believe. But for example, perpetuals. For example, the niche tokens. For example, also lower transaction fees. Prediction markets. Like we talked about this. For anyone wondering, we have this. How do you say this? We have Polymarket, and on Polymarket, you can basically bet on anything. So today, we're also going to check how many times does Jerome Powell say inflation. And every time Jerome Powell says the word inflation, we'll use his soundboard. So I hope he won't say too much inflation. Let's see though, let's see. Guys, about 5 more minutes and we go live. But yeah, it's Cronos is good. It also has now some free transaction fees, so you don't pay any gas fees, or you pay gas fees, but you will get a rebate afterwards. So if you guys are new to Cronos, check out Cronos 1. It's the perfect starting point for anyone. It would be so nice for the market to react positively for once. Yes, please. Don't be like the shitcoin. I don't know. It's having a hard time at about 93. It needs some truly bullish words during the meeting. So the first 5 minutes, I would say, are the most important, guys. So I will shut up. I will shut up during the words by Jerome. And we will have to watch what happens with the charts. No worries, David. We all have to learn together. I mean, I probably sound like a douche, because the thing is, if you use something for a long time, it becomes so easy to you. But it's the same thing with it. When I started to learn to drive, I hated that my father was sitting next to me, because of course he knew everything already. And I was just getting started with, you know, learning to drive a car. But some things just take some experience. And some things look obvious, but they definitely aren't. Definitely aren't. I mean, if I, like the first time I saw a clutch, we have, we do everything manually in Europe. We have manual cars. The first time I used a clutch, I was like, do I need to, you know, press it once and then then shift, or no? It's hard. Do you know the current amount of participants? No, don't know. I can maybe check. Every QE mention will take a drink. I don't think he will say that. I don't think he will say out loud quantitative easing, because quantitative easing is a bit of a dirty word for a federal chair. Oh, Robert, thank you so much. Inflation! Woo! Next time we'll get a disco ball as well. Thanks you so much. Thank you so much, Robert. I don't know this music. There's background music. I don't know what to think of it. So, guys, I'm gonna do something now. I'm gonna like the live stream by the Fed. So that's a reminder to also hit the like button and, you know, subscribe. I'm not logged in, it seems. Okay. Almost there, guys. 1 more minute, then Jerome Powell will start his speech and I will shut up. Bitcoin at the moment it did nothing. So we got the data. We got, guys, the rate cut. We do have a rate cut now. The rate cut is here. As expected, 3.75%. So a small rate cut. Nothing too big. The big news so far has been that we will see the first buying of treasury, so 40 billion US dollars. We're getting more capital injection. Capital injection, guys. 1 more minute. Let's go. My body is ready. There we go, guys. I'm gonna shut up. I will keep the charts open though. I'm saying though, he's gonna start with good afternoon. He always does so. He always has good afternoon. Thank you, David. Soon we'll hear the scary good afternoon. There he goes. There he comes, guys. There he is, Mr. Jerome Powell. Let's listen.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time.
That's big, guys. QE.
Thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year.
Did I miss an inflation?
A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
Coming up,
inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. Downside risks to employment having risen in recent months. The balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a 1/4 percentage point.
Nice.
With today's decision, we have lowered our policy rate 3/4 percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy.
Nothing changed here, guys.
The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations as well. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Yes, this was a good dovish speech. I love it.
Thank you.
We can go
Howard
higher.
Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
So far, so good, guys.
Thank you, Mr. Chair,
down.
for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say,
looking forward,
as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the two parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I could make that case. It's a close call. We have to make decisions. And we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make and that kind of thing, and what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Interesting. So basically, you said that 9 out of 12 members agreed. But 3 disagreed.
There's been some
Interesting.
discussion recently of the 1990s. In the 1990s, the committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set, but you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now, and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's going to come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in reserves, in an ample reserves regime. So, you know, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, you know, we announced that we're resuming reserve management purchases.
Kiwi
that
boys.
is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, you know, if you look ahead, you will see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Stable, Teddy, stable, very stable. What is good news? Very good news. QE
Thanks, Mr. Chairman.
a little bit.
This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. You know, we're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but you know, this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, you know, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That, you know, we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, you know, there's the announcement of a tariff, and then there's, you know, they start to take effect, and then it takes some months goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Nope. Interesting.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Would like that. Healthy economy.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Good question, actually.
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at.
Guys, we're going.
But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs and there are enough jobs for people. This may be different. You know, it's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
You know, it's not so stark as that. The views are more varied on in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And
oh boys, we're pumping.
I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low low-rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move, and we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Like and subscribe. Let's bump it.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are there inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that.
Oh, Ethereum.
I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
Thank you.
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's, I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman, Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
That's it. That's it. Teddy, thank you so much. Interesting. So we stopped the show and it's dumping again. Ay. He is a legend. He definitely is a legend. Okay. Can we check if my cam check 212. Check. Oh no. Oh, they shouldn't have done that. No, the camera's not happy today. Oh shit. Ay. I'm stuck, guys. Give me a few seconds. MK, you've just missed it. Good gracious, guys! What a show so far. Oh no. Hello? Are we back? Are we back, boys? Okay, so quickly, let's do the market update. Unfortunately, no. We are stuck. So no cam, as usual. So quick recap, right? Because what just happened? So to be honest, not too much. Not too much. We got what we expected, and so far. Oh, this is actually quite interesting. You see that the price action, we test here this level, and then we have potentially a go so far. We had a good jump here. Anyway, so what happened today? Most important takeaway, we did get the rate cut. We got a rate cut. We got a rate cut. Let me check. Different chart. This one. You can see we've got a rate cut today. We went from 4% all the way to 3.75, which is great. But I think the headline isn't necessarily not the rate cut. It's this. It's this, guys. The Fed says it will start buying US Treasury bills on December 12th. In only 2 more days, ladies and gentlemen. And it plans to purchase $40 billion in only the next 30 days. That's huge. That's huge, guys. That is basically... It's getting close now to QE. It is getting very close to QE. So this is exciting. I think this is also why we are going up. I think the environment is bullish now. We didn't expect like this quick of a turn really for the Fed. So guys, this is good stuff here. This is really good stuff here coming from the Fed here live. And not only does it affect the crypto markets, it also affects the S&P. The S&P now is back to the previous highs. Or back to the Friday. The Friday and Thursday highs. So that's really good. Good start so far. So we're getting within only 0.3% of the all-time high for the S&P. 0.3%. Ethereum, bit down again, but it went all the way to 3,450. That's looking good. Bitcoin dominance, still massive red candle. Massive red candle. Bitcoin... Again, this is looking good. We're close to this trend line here. This is the real test. And this orange trend line at about 95k. Are they loading up the USB drives for the money printer? I do believe so. We're getting very close to actual money printing, guys. It's good. The USB drives. It's been a long time since I last used a USB stick. What's up, MK? Guys, it's good stuff. It's honestly good stuff. I do believe longer term, these are the 5-minute charts, but if we zoom out, this is what we need. This is what we need to go back towards $100,000 and then potentially also 106. We've been talking about that for a long time. More and more reasons to believe we have had a local bottom over here. It was rough, but it was good. So I want to give a quick shout out to all the beautiful people here in the chat today. Unfortunately, my cam is down, but I want to give a big shout out here to Robert. And again, Robert, make sure to join the Discord. We will arrange something. So Robert, thank you so much for the gifts and also the subscription to Star Fox and also to Teddy, because Teddy is a legend as well, a legend and a scholar. He gifted to somebody. I can't see to who though, but somebody got very lucky today, so thank you very much, Teddy. Yeah, it's good, guys. Good stuff. Very good stuff. Bitcoin is looking good. We're tracing a little bit now, but it's all fine. Most importantly, I do believe, yeah, this is a great pump here. You can see the total crypto market cap. It tried to go down last week, but it's also again going up. Great start so far of the week. And we still have a few more days to pump, of course, before we hit the weekend. I think Powell is on Santa's nice list. I think he will leave. He will leave as a bullish Powell. I like bullish Powell. Goran, thank you so much. Welcome. You have to thank Terry or Teddy. Keep buying, keep holding, and sell when the time is right. That's no financial advice, though. I think that's very solid advice, though, even though if it isn't financial advice. Guys, I can't show my face anymore. The cam is yeah, it's frozen. It's bear market for the cam. Crow's looking good though. I would say the overall market's looking good. I'm happy. I'm just very happy. And I'm gonna end on that note, guys. Tomorrow we don't have any stream. Tomorrow no midweek update. But this was the midweek update for this week. I'm bullish. Truly, good vibes. Guys, we've been live for almost 2 hours now, so I'm gonna say goodbye. I'm gonna go to bed soon. let's continue to talk on Twitter. Let's continue to talk on Discord, and then I hope to see you Sunday with the weekly close. So Sunday we also have a stream. So make sure you hit the like button, and you also strap in for more content, because soon we're also going to talk about the time to buy video. So very, very exciting time, guys. Talk to you guys very, very soon. Legends. Yeah, like button. Yes, yes, yes.